But now, let's move to macroeconomics. If micro is like a magnifying glass, then macro is like a big map. It allows us to see the whole landscape, the entire economy of a country, or even the whole world. Here, we ask big questions such as, is GDP, the size of the economy, rising or falling? Is the economy growing fast or slowing down? Is inflation climbing higher and higher? Are interest rates high or low? Is unemployment increasing or decreasing? Are currencies getting stronger or weaker compared to each other? These are the questions that professional investors always follow, because macro factors affect everything. The stock market, real estate prices, gold, even foreign currencies like the US dollar. Every single investment is touched directly by macroeconomics. That's why if you are going to invest your hard-earned money you worked so hard for with your sweat and effort, you must understand these macroeconomic indicators. Knowing macro is no longer optional. It is mandatory in today's world. Let's make this practical. Stocks. When GDP goes up, it is as if the whole forest grows more easily. Good companies, as the strong trees, can grow faster, so their stock prices are more likely to rise. When GDP goes down and the economy slows, even great companies feel the headwind and growth becomes harder. In simple terms, when GDP rises, demand, sales, and profits tend to rise, and stocks often go up. When GDP falls, demand, sales, and profits tend to fall, and stocks come under pressure. Now add inflation and interest rates. When inflation rises, the central bank usually raises interest rates. Borrowing costs then go up, spending goes down, profits decline, and stocks tend to fall. This is why smart investors do not only study one company, they also check the weather of the whole forest. Real estate. When interest rates go down and loans are cheap, more people can afford to buy homes. Demand increases and prices often rise. When interest rates go up and loans are expensive, fewer buyers can afford a mortgage. Demand falls and the housing market may slow or pause. In short, lower rates reduce mortgage costs, lift housing demand, and often push prices up. Higher rates increase mortgage costs, reduce demand, and can cause prices to stall or fall. Why both macro and micro matter. The two-lens rule. Always think with two lenses. First is the micro lens, like a magnifying glass. Ask, is this business good? Is this neighborhood strong? Look at the profit model, the competition, the company's pricing power, local jobs, and local demand. Second is the macro lens, like a big map. Ask, is the overall economy supportive or restrictive? Check GDP growth, inflation, interest rates, unemployment, and currency strength. Here is the rule. Good micro plus good macro gives you the best odds. Good micro with bad macro means be patient and use a smaller position. Bad micro with good macro might only suit a short-term trade and requires caution. Bad micro and bad macro should be avoided. A great company during a recession may survive, but it will grow more slowly. Cheap mortgages can pull demand into real estate. High inflation often pushes interest rates up, and higher rates put pressure on stocks. When you say these ideas and write them down, your brain begins to own them. Your 60-second checklist before investing. Start with the macro pulse. Is GDP rising or slowing? Is inflation stable or high? And are interest rates rising, flat, or falling? Then check the asset match. Stocks prefer growth with reasonable rates, while property prefers lower mortgage rates and strong local demand. Confirm the micro-reality. For stocks, look at the moat, margins, debt, and market share. For property, look at jobs, infrastructure, schools, shopping, and transport. Finally, set position size. If both macro and micro are good, it is okay to size up. If there is any red flag, reduce size, demand a better price, or wait. Common beginner mistakes and how to avoid them. The first mistake is looking only at the company or the house and ignoring the economy. The fix is to always check GDP, inflation, and interest rates first. The second mistake is watching only macro news and ignoring the actual business or neighborhood. The fix is to visit stores, read reports, walk the street, and touch reality. The third mistake is rushing decisions. The fix is to use the two-lens rule and the 60-second checklist every single time. Gold, the safety asset in stormy weather. If you invest in gold, remember this: when inflation is high or the economy feels unstable, many people want to protect their wealth, so they buy gold. Gold is viewed as a safe store of value. That is why, during crises or recessions, the price of gold often rises. We can see this pattern even now. When people lose trust in the economy, they run to gold as a safe place to hold value. In short, when uncertainty rises, demand for gold rises, and gold prices tend to go up. Now let's move to currencies. Take the exchange rate between the US dollar and the Vietnamese dong. When this rate changes, it affects many parts of life. Imports and exports. If the dollar becomes stronger, imported goods cost more in local currency. Exporters may benefit, but consumers pay higher prices. Consumer prices, everyday products from electronics to food, can become more expensive when the exchange rate shifts. Foreign investment. Investors look at currency stability before putting money into a country. If the local currency is weak, it can scare them away. So you see, exchange rates are not just numbers on a screen. They affect everything: your shopping bill, your daily expenses, your country's ability to attract foreign capital, even your long-term investments. Think of it this way: gold reflects how much trust people have in the economy. Currencies reflect how much strength a country has in the global market. Both are critical parts of macroeconomics. Quick reflection. When inflation is high, gold demand goes up. When the dollar is strong, imports cost more. Exchange rates affect both investors and consumers. If you speak it and write it, your brain doesn't just hear the idea, your brain owns it. So after everything we've shared so far, there's one truth you must remember. To invest wisely, you must understand both macroeconomics and microeconomics. Why? Because if you only know one, you are half blind. Example 1, only micro, no macro. Imagine you take care of a tree very carefully. You water it, you fertilize it, you protect it from insects, but you don't see that a storm is coming. That's what happens if you only study micro, the business details, but ignore macro, the bigger economy. A great company can still struggle when the whole economy slows down. Example 2, only macro, no micro. Now imagine you know the direction of the whole forest. You can see sunshine, you can see rain, you know the weather is good, but you pick the wrong tree, a weak one that is already dying. That's what happens when you understand macro, but you cannot judge which business is strong or weak. True investing requires both lenses. Micro helps choosing the right tree. Macro helps watching the weather of the forest. If you invest in stocks or real estate, macroeconomics is like your radar. It tells you where the economy is moving. Is it shrinking? Is it recovering? Is it overheating? When the economy is in recession and just starting to recover, asset prices are often still low. That is when opportunities appear. Gold may rise. Property may still be affordable. Stocks may be undervalued. When the economy grows too fast, inflation climbs and the central bank raises interest rates. That is often the signal that asset prices are already high. At that stage, most people take profits, and it's usually not the best time to keep buying more. Now, let's talk about the traders. If you are someone who likes to trade short-term, jumping in and out of the market, then you must be extra careful. Because here's the truth: when the market is unstable, you may make money on one move. But if the market suddenly crashes while you are careless, the loss can be very painful. That's why understanding macroeconomics is so important. It helps us catch the big cycles of the economy. And these cycles don't move overnight. They take time. But here's the good news. When you can recognize the cycle, when assets are cheap and the economy is weak but about to recover, that's when your chances of success are much higher. Think of it like a farmer. A farmer must watch the seasons. When is it time to plant the seeds? When is it time to harvest the crops? If he plants at the wrong season, he will waste effort. But if he plants at the right season, the harvest is rich. Macro is like watching the seasons of the economy.